Okay, we're going to do the last one. IAS 7. Cash flow statement or statement of cash flow. So it's part of the final account actually, but it's also having a separate standard. Even though it's part of the IAS 1, you have to also do it separately. So generally, the users would like to know how much they have as a way of the cash in the business. Because the income statement is prepared on an accrual basis. So sometimes you get more profit, and the question is, it doesn't translate to be the remaining cash balance in the business account. Or if it is less profit, they still have more cash in there. So they don't understand why we made a loss, but you have cash in the business. Then that the cash flow statement comes in. So the cash flow statement is just going to show the movement of cash in the organization, the movement of cash in the organization. Fine, sometimes the bankers will require you to get the cash flow statement because they will have to know how you spend the money and how the money comes in. So that if they give you the loan, they will know where they can get their repayment from. So it's very important that we know how to do it and finish with the quoting as such. Okay, so here it is going to be highly mechanical, the final account. So the calculation, if it is going to be a theory, then what is the importance of the cash flow statement? Then you just have to give us why you do the cash flow statement. Okay, but with the we have only 3 areas: the operation activity, the investing activity, and the financing activity. That is the heading that you are going to use in preparing the cash flow statement, and it is simple. It's not anything that is difficult for you to think about it. With the operation activity, there are 3 different methods to do it. We have the direct method and the indirect method. But the standard always comes with the indirect method, which, because the direct method is a little bit inconsistent as we want to compare. Because if you are doing trading and I'm doing manufacturing and another is doing, how you get that direct method is going to be different. So that's why the person or the examiner always wants us to do the indirect. For the indirect, you all have to start from the income statement side. And that one is something we can compare. But if you are manufacturing, that means that you are going to do your material, whatever. And if I'm also trading the purchases, if somebody is a service, it's going to be something. So we are going to concentrate on the indirect method in there so that you go through with it. Then the investing activity is also how we invest in our business in order to make up for the expansion in income. Then the financing is going to be where we are going to get a source. How do we get in financing our business? Whether we issue shares or borrow for long-term expansion of the business. How we take this one into the organization that is normally the assets, and how the assets also help us to generate the income. So as simple as that. That is the only thing that we are going to do. But there's a format for us to look at it. We just have to look at the format. And we summarize the format so that it will be okay for all of us to follow. So let's still go back to the book and get through the format, and it is okay. So the same place that we were, right for the page number. So let's go to 468. The same book. The same book, 468. If others will also send us the pages by screenshots, it's also okay, so that we don't go through the bigger book. It's like you scroll down. If others can give us the honor to give us the screenshot, it will be simple for the phone here. Okay, but we are going 468, right? 468. Okay, so 468. Almost the last part once you get there. So profit before tax. You start the cash flow from operating activity from there. Then for here, we are just adjusting the figures. So if there is any cash or the non-cash,
Too slow onto the ball, playing in dangerous areas. You can see Zuma into Calvin Phillips. It's a poor pass, but he should be better than that. He should be quicker onto it. He does get the touch. He's not aware that Solanke's in behind him, obviously. Just toe pokes it back. He toe pokes it back straight to Solanke. He just puts it in easily. First half goal at home West Ham have conceded this season. Cavalier's ball in. It's a good one. Senesi drives it over. Oh, they started this game brilliantly, Bournemouth. Scott again. Put in a real Rolls-Royce performance in the FA Cup against Swansea. Absolutely outstanding. There's the long-range drive. Wow. Great strike from Lewis Cook, who's never scored a Premier League goal. Started the last league game, didn't he? Fornals. But does look like there might be a move.
if there has been a loss, you have to add it back, right? If there has been a profit, you take it off. So you adjust based on whether it has been added before or subtracted before. So if it is added before, we add it back. If it has been added before, we subtract it. That is simple. That is for the adjustment for non-cash transaction. Then, before you get the profit before interest or before tax, profit before tax that you would have taken the finance cost. The finance cost is based on the accounting preparation accrual stuff. So we just want you to add it back if you have taken it, so that you come back down somewhere to do the cash payment actually. So all the adjustments supposed to be done as such. So the interest expenses will still be added back. If there is interest income, as I told you there, other income will also be added. Other income before the finance cost. So if there's other income in there, what you have to do is that it has already been added. So you take it away from there. That is not where it's supposed to be. Then, if there's amortization on government grants, all those are just exchange gains on foreign currency transaction or losses on foreign currency transaction, you don't pay anything. So you have to adjust for that. Then, we also come and work on the current asset and the current liability. So the changes in the working capital. Changes in working capital. So the working capital, any changes in the working capital will also affect whether you are going to get more money or you are paying more. So here we concentrate on the current assets and the current liabilities. The current asset and the liability. But specifically, you have to look at inventory, the receivables, and the payables. That is the only thing that we consider. So on the current liability, only the payables. The current asset, then you have the inventory and the receivables. So look at the changes in that working capital figures. Which is the current assets, current liability. But the concentration is supposed to be on the inventory, receivable, and the payables. Okay. So after you adjust that one, then that you come for the actual payment of the taxes and the interest. The actual payment of interest and taxes. This one means that you have to pay based on the standard. So the payment, the paid is what you want here. Down there, after adjusting for the working capital, interest paid, tax paid, then you just have to do it. You know the tax paid has been based on the IAS 12. There is tax provision, there is also over and under tax provision, there is deferred tax that you send there. Here, you want how much you pay for the year. So the amount that you pay for the year is what you are supposed to do, the actual amount. So you will have to adjust the figure to know the actual amount. The same thing from the interest or the finance cost. We want the actual payment, not on the accrual basis. So you have to work on that. Then you are done with the cash flow from operating activity. Cash flow. So you bring the balance and you say net cash flow from operating activity. That is the first. Any question? Then you go to the investment activity. Investment activity. So within the investment activity, we are saying that it is only concentrating on the current asset. Sorry, non-current asset. The non-current assets. How much investment has gone into the current asset? So we are talking about the additions and the disposals. The additions to the current non-current asset and the disposal. So all the fixed assets or the non-current asset, have you bought any of them? Have you disposed any of them? And income. So the income that we took from up there will also come in. Income from investment. Income from investment. So the finance income that was up there must be removed and we put it under the investing activity. With the investing activity is going to concentrate itself on the non-current asset. In the generation that came in through the non-current asset, as in the form of income from investment, or finance income, or other income from the investment that we have made, will also be there. But the much question is on the additions and the subtractions. Additions and the subtractions. So here, if it is difficult, then you have to prepare the asset account. The asset account. You have to make sure that you prepare the asset account. In the asset account, the opening balance is always at the debit side. So the balance going forward will be here. The pricing will be down there. If there is any addition, because you need the addition here, so maybe the addition will not be given to you. If the addition is not given to you, then within the year, has there been any disposal? Has there been any depreciation? Has there been any revaluation surplus? Revaluation gain will come here. If there is a revaluation loss, it will be here. Has there been any impairment on the asset? Impairment. If an asset has been financed through a lease, so lease finance will come here. So you do all the assets items that will affect the asset or the non-current asset to know whether there has been any addition. So that the difference will be addition. If the difference is not there, it may be that there has been some disposal somewhere. So you have to know the disposal. Because the question requires you to get the addition or the disposal. So the closing balance will come here, balance by down, and you balance it off, and the difference will show as in the addition, or the difference will show as in the disposal. Then you just come and fix it in. At times, to profits or loss on disposal, they have to be calculated from the question. So if they say that the carrying amount of the asset, the carrying amount of a certain asset is given and it is sold to gain a profit, there was a gain on the disposal. If there is a gain on disposal, that means that the carrying amount plus the gain will give us the value of the asset in the, or the proceeds that was received. So the proceeds supposed to be in the statement. So at times the proceeds from disposal supposed to be here. And that proceeds may not be given to you. They will say that the carrying amount was that and there was a gain or a loss, whichever. There was a gain or loss on disposal. So if you put that one in there, that means that you are getting the proceeds. The proceeds that you have to send it to the investment activity. So here, the acquisition, the cost of acquiring it, or the proceeds from that disposal supposed to be in there. So whichever way that supposed to be there, you have to calculate it and get there. Any question on that?
So the asset financed by lease.
The asset financed by lease, we want to get the total asset for the entity. So at times, the opening balance is there, and there is an additional asset that is financed through lease. If that is the case, it's supposed to be part of the asset, right? So in order to get, if there is any other additional asset that we pay, there can even be that there is a credit asset. That means that we do not pay for it. So if we took any asset on credit, then it will still be added, just that we have not paid for it. So you have to get the actual payment for additional assets, not the one that we did not pay for it. So you, through the question, you get to know all these kind of things. Let me solve the question. And this one may also be there for you to get it. Sometimes the proceeds will be given to you straight away. Sometimes the carrying amount and the gain will be given to you. Then you have to find the proceeds. You have to find the proceeds. If also the question is also under the operating activity, it could also be that they will give you the carrying amount and the proceeds. Then you have to find the gain or the loss. If you are finding the gain on the loss, that means that it will come to the operating activity. So you have to be familiar with a gain or loss on disposal of non-current assets will be in the operating activity because it's not adjusting cash transactions. So if this one is not giving, then you find it so that you adjust this one in the operating activity. If this one is giving, you have to find the loss so that you adjust in the operating activity. Okay. So that is for the investing activity. Then we go to the last one, which is the financing activity. Financing activity. So with the financing activity, if we issue any share, so with the financing activity, it's about the shares or the share capital, and the long-term liabilities. The share capital and long-term liabilities. So where we got our financing our projects. So if there is issue of shares, if there is redeemed shares, so if you issue shares, it means that more money is coming in. If you also redeem some of the shares, it means that you are paying some of the shares off. It may even be that debenture, you could get more debenture, or we are paying it off. Then, as for dividends, you can treat it here or there, but normally we bring the dividend here. So dividend payment, the actual amount that we pay, also comes under the financing activity. So all of our finance, how we procure, or we also pay back the money that we use in financing our business will be under the financing activity. So it depends whether we are paying it or we are receiving it or we are redeeming it or we are issuing it. Okay. Then we also get that amount to be the net cash flow from financing activity. Then you add the three sections. Yes, please.
Because what if you get an interest on maybe you made an investment and you get interest on it?
Investment is in the investment activity. So every investment that you do is here. So you bring all of that there. As we said, it will be in the operating activity, but you have to adjust it and send it here. So the actual income that you receive is what's supposed to be here. The cash that you receive. But at times, if there is no additional information, the same figure here will be the same figure there. Okay. Any other question? So, as we have done it, the net cash flow from operating activity, then the net cash flow from investing activity, the net cash flow from financing activity, you put all of them together. And that figure will be a positive figure or a negative figure. So if it is a positive figure, then you write increase in the cash and cash equivalent. Increase in cash and cash equivalent. If it is a decrease, then you write decrease in, that is negative. If it is negative, it is a decrease in cash and cash equivalent. Then, so increase or decrease. Increase or decrease. Then you have to add the opening cash and cash equivalent. That will be given to you in the question. So if I were to ask for that one, even though I'm not doing this, that one I have to bring it because it will be in the question. Opening cash and cash equivalent will be in the question. Then the closing, as you put it there, whether it's an increase or decrease at the opening. Then the closing will come. You add or subtract and closing cash and cash equivalent. That one will also be in the question. So whether it's an increase or decrease, then you are done. So for the last three figures, please, if you are not doing anything, write the heading and bring them. Because it's there in the question. Sometimes you don't have to pay. The opening cash and cash equivalent and the closing cash and cash equivalent will be in the question. So you have to write it. And even the third one, you can get it. Because so far as you have the closing and the opening is given, then the difference will be the increase or decrease. So even if I add and it's not telling you, I will still have the figure right. I have to pass the exams. So if let's say that the opening is 500 and the closing is 600, it means that this one has been added and it's 100. Even though I have not reached it yet, I'll put it there. And say increase in cash and cash equivalent 100. I'll add it and get it 600. Because this one will always be given, this one will also be given. So while waiting to add, I mean, what is the issue? We don't want to pass. So it's an exam that we are doing. It doesn't mean that we understand. We will still pass. The bar officer, I have very good news. Please, you have to be, I mean, get the tactics to pass. Get the tactics to pass. So when you know what passing and the person will be writing and will not be passing. You want to do everything French. Yeah. Okay. Any question? Any question? But please, it's a format. So you are supposed to pass through that format straight away. And it's not difficult. You can jump from one to the other, but get the headings there and jump. It doesn't change anything. Get what you know in the person that is familiar. It's only the asset that sometimes it's a little bit confusing kind of. Apart from that, the other ones will be there for you to put them in. So if you think that the investing activity is disturbing, you put the heading there, leave a space, jump it, and get the other marks and go. Don't waste the time there. And come and do your QC. It's also having a mark. So you do it. So let's answer. And later on, you need to match us out. But to see how they can really be this. Okay. So you do one question and I guess you are tired. Then you all go. But please, when you go, solve the questions. Solve the questions. It's very important that you have to solve the questions. You have to solve the questions. As a really decent see, I'm going to get it. Okay. Okay, let's do the question number. I guess with the intervention to bring another question for you to do. Question number 4. The quantity limited. It is 479. 479. 479. Quantity limited.
Fine.
Okay. Quantity.
Prepare a statement of cash flow for 2020
Okay.
for the year ended 31st March 2011
Okay.
in accordance with IAS 7. Statement of cash flows using the indirect method.
So the question requires us to use the indirect method. So we don't have any option than to use the indirect method.
So can you be asking the direct?
But since, as I said, since that one is inconsistent with each of the business or industry have its own direct way of getting the cost. So it's normally not examinable. Because if it is manufacturing different, trading different, service different. So you want us to be comparing the figures. So you use the indirect so that everybody will free. Okay. So we are supposed to prepare cash flow quantity limited, cash flow, or is it what? Statement of cash flow or cash flow statement?
Statement of cash flows.
So it's not like the question statement of cash flows for the year, right? For the year ended 31st March 2011. Okay. So you have your currency sign. Those on the top. I learned today they are graduating.
Yes.
Okay, let's move on.
Okay.
Just know how to do it, and even if it is 20 additional information, just take it one after the other, and it's okay. That's what I told you. When you pass, then you can come and flex. Other than that, you can't complain. Okay, let's continue.
Quantity Limited is a public company. Its most recent financial statements are shown below.
So the financial statement always it will be 2. 2 years will be given to you, and 1 year will be the old one and the new one. Every year is going to be two financial statements because you want the changes in 1 or 2 things. It's still going to be 2. So when you look at it, it's not ratios. It will be a cash flow. Not a ratio. Okay, let's move on.
Notes.
Okay.
I. There were no disposal of non-current assets during the period.
So no disposal of non-current assets during the period.
However, Conte Limited does have some non-current assets classified as held for sale
Okay.
at 31st March 2011.
Okay, so there is non-current asset that is classified as held for sale. Okay.
II. Depreciation of property, plant, and equipment for the year ended 31st March 2011 was 640,000 pounds.
Okay, so the depreciation figure is given down there.
A disappointed shareholder has observed that although revenue during the year has increased by 48%, profit for the year has only increased by 20%. Required.
So maybe why we have to prepare the cash flow is because somebody is disappointed that there has been an increase in revenue, but the profit itself has been a lot of reduction in there. So the person wants us to prepare the cash flow so that if the business is still the correct, then the person continue to invest in it. Okay. So the requirement is you are supposed to do the cash flow using. Then the B point is saying what?
B. Using the information in the question and your answer to A above, comment on the performance, including addressing the shareholders' observation and financial position of Conte Limited for the year ended 31st March.
So the person still wants us to look at the issue of what the shareholder is saying, so that you'll be able to distinguish between the cash flow and the income statement. Because he is disappointed that no, so far as the profit has increased by that, then the revenue has increased by that, the profit shouldn't be like this. So you have to use the distinction between the cash flow and the income statement to argue the point. Okay. So the cash flow statement, and we are saying that the first point is to get the headings. The cash flow from operating activity. Cash flow from operating activity. That's supposed to be one heading. And normally in the exams, as I have said, the requirement is what you have to do. So please, you can bring this one, the full page. Then the next page, half of it is cash flow from investing activity. Then half of it will also be cash flow from financing activity. Oh, pass you. We just over the So that is what you are supposed to do. You have your headings there, at least. If you say stop work, you were doing it just at the time. And but if you don't do anything and it's there like that, there was no even heading. You don't want to pass. That's a weird. Aha, I said that they are there. So because the question says that attempt all questions. So this one have attempted it. You don't want to be that person. So you have attempted it. Just that the figures are not in. Okay. So you said that you start from where? Profit. It's not for the year. For tax. So you go to the income statement. So the operating profit from operating activity, all of them, you are taking it from the income statement. Then you also go to what? The working capital, which is the current liability and the current asset. That is where you do the thing. So our concentration will be the two components, income statement. So we are going to the income statement. And you are breaking all the items from there. The profit before tax, how much is it? 5250. So 5250. 5250. Then you say that we adjust for non-cash transactions. So you go back small on the income statement. So the next thing is what? Go back, like from the figure that you have written. The next item will be, you go up. Go back up. The next is finance cost. So finance cost has been deducted before this one. So what do? So you write finance cost. So if you want to use this side, fine. If you also want to use this side. So we are adding how much? So it's 650.
Yes.
Just put it. We are adding. So you don't bracket it. Okay. The next item. So the next thing is administration cost. That one, there's no analysis to tell us that this non-cash item is in. And the next one is what? That one to no analysis. The cost of sales, no analysis. So you end there. Then you come to the additional information and check what has happened. Is there any depreciation, impairment, profit on disposal, loss on disposal, all the adjusting issues that we were talking about. So sometimes when you go back, you get some of the items. When you get to the top, you go to the additional information and check. So additional information, what are there? Is depreciation there?
Depreciation.
Yeah, depreciation for the year. So depreciation. It has been deducted. How much? 640. So we add it back. If there is amortization, we add it back. Loss on disposal, we add it back. If there has been any gains on disposal, we take it out. So as simple as that. Do you know that the bank get for class in the final accounts of? Okay. Any question? So almost like we have done. We have finished almost. So there is no profit on disposal. There is no loss on disposal. So all that we have to do is also look at how much tax and what do you call it? Let's look at the working capital. Let's add this one. The total.
6540.
6,000. 6,540. So this is a normal cash generated from the operating. But if you don't want to put the head in there, stop it. It's okay. And go and continue. The cash generated from ordinary activity. But if you don't want to put the head in there, just leave it. Then the working capital. The working capital. That is changes in working capital. Now, if you don't want to put the head in there, don't write it. It doesn't change anything. You make the password. And block all these ones. And now, the increase or decrease in the working capital. So you go to the financial statement. Sorry, the financial position. The changes in inventory. You pick the current assets. Current assets. The current assets. Are you there with the current assets?
Yes.
Okay. So with the current assets, what are the items? The changes.
Yes.
The changes. Has there been any increase or decrease?
Increase.
So what you have to put at the back of your mind is that for assets, if there is increase in assets, it means that we are paying more. We are paying more. So if you are paying more, your cash is growing. So the increase will be a deduction. Less. If there is a decrease in assets, it means that you just have to add for assets. If it is a liability, an increase means the opposite. And if you are not paying, or if they are financing you, kind of. If you are not paying, it means that they are financing you in a way. So you go and borrow the things to sell. It means that they are financing you. So they are giving you more cash. So for liability, if it is an increase, you add. If it is a decrease, it means that you are paying them back. So you subtract. So you have to put that one at the back of your mind too. So the increase and decrease in the working capital issue. So you look at whether it has been increasing or decreasing. You just have to check the figures. So at the beginning it was how much? 1,800. And at the end it is 3,600. So we write increase in inventory. Increase in inventory. If you want to put the figures there, 3,600 minus 1,800. And that one will give us how much? 1,800. It's an increase, and increase means that we have to subtract. As simple as that. Then we have the receivables. The trade receivables. Is there an increase or decrease? At first it was how much? And now it is
2,100.
okay. So increase again here. Increase in inventory, receivables. And that one is 3,000, 2,400 minus 1,400. And the difference will be 1,000. It's also increase. It's also an increase. So more people are owning us. It means that we are financing them. So it's like we are paying something to them. Any question? Then the last one, the payout. Is it decrease or increase? It was how much? 2,150, right? That one is also an increase. So your increase in payouts. How much? 2,150 to 2,800, right? 2,150 to 2,800. So the change is how much? 657. So it's a liability. And if we are increasing it, it means that they are financing us. It's like you're receiving the money. So the change in the liability, if it is an increase, we add. So I'm adding, I'm not going to subtract. I hope it's simple. So please, even if you write a profit before tax, and you write this one and additional information, you are not even seeing depreciation. Ask for this one too, can't you do it? Hey, you still want to fail. You go and check the 3 years difference. Come and put them there. You are moving on. You don't have to fail. It's not we who are going to finance ICA through exams. When there's Canada, you don't pass it. Other than that, you'll be paying, they are charging now is 500 and something. Master, that's when me and mama not buying. Because at first the difference between the level 3 and 2 was wide, and now it's closer. That one is 585 or so, and yours is 550 something. Okay. Then there's a gap. But it doesn't mean that it happens. Any question? Any question, please? Any question? Okay. Like what we did, you will see the question will be, as for this one that is not in, but sometimes the question will say income received, depreciation, amortization, profit on, so they will be saying, even if it's not here, when you go to the additional information, it will be in. So the additional information, some will be talking about depreciation, some will be talking about amortization, some will be talking about profit on disposal, some will be talking about loss on disposal, impairment loss, and all those things will be in additional information. It will not be here. So if it is not here, go to the additional information and there is the same. Because we know that the impairment will be treated in the income statement, right? The profit on disposal will be treated in the income statement. So only the few that you see here, you adjust it. Then go to the additional information and start with the adjustment also. After you are done with it, come to the working capital and do it. So that is a start. That's why I told you that before you even go, you know what to do. It's not like then that you are going to see that, oh, I want to see whether I'll pass. You are supposed to pass before you go. Because if it's cash flow is coming, you know that immediately I write the heading, no profit. That is where I'm going. Then after the profit, I'll adjust it back. After I finish and there is nothing there, I'll go to the additional information, read depreciation, pick it, amortization, you pick it. You are passing. You don't read a lot of things while you are not writing anything. So you pick them and you come and if there is nothing there, you come to inventory. The current assets and the current liability. Go and check them. You put them there. Then the final thing is we are going to look at the cash payment of the tax and the interest, the finance cost. Then we are done with this side. So you have to know that as I'm going, this is what I'm going to do. It doesn't matter what is coming. Any sentence that confuses me, I will jump it and go. Other than that, you'll be there and it's like you are not writing anything. And the 100 marks for the 3 hours, when you divide, you see that any minute you have to get a mark. You have to get a mark to pass. Other than that, you still complain. So it's not there that you are going to read to 10. Go and write what you do and come. Okay. The other income will be in the income statement. But we said that when we are adjusting, the other income is supposed to be here. It's supposed to be under the investing activity. So if it has been added, you take it out. So as I started with this, then the finance cost, the other income would have been here. So I write income from investment and bracket it. That means I will take it. When I see that there is no any additional information on it, I will bring it here straight. Or I can write the heading, income from investment, so that I will wait. If there is no additional information, I will put the same figure which I subtracted there. So you have to be fast.
So you treat the finance cost.
And that is, we are still going to treat it here. Just that it's supposed not to be up there. So this finance cost is the interest payable. It is treated in accordance with the accruals. But you want the cash that was paid. So I'll adjust and add it back. But I'm going to write the actual payment here after the working capital. So you go back again and check whether there's a difference between that and that. So where there's a difference between that, you see. Okay, so the interest, we are done with the working capital. Then the interest paid. Interest paid. We want the actual finance cost that is paid. So interest paid or finance cost paid, that is what you have to bring. So where you are going to see is that one is in the income statement as in here. Then you go to the liability, the current liability, and check whether there has been any interest at the beginning and interest at the end. If there is no interest at the beginning and interest at the end, it means that the same thing has been paid. You get it? Normally, this one is interest payable, the one here, because it's supposed to be treated in accordance with the standard IAS 1, and it is prepared on accrual basis. So all the interest that's supposed to have been paid is this one, right? So if you put it in the income statement, then you have to go and pay. If you haven't paid, it must show itself in the liabilities that you have not paid that interest. Double entry now. So if it is not paid, the interest not paid is a liability. So if it shows itself in the liability, fine. We go and look at it. But as I said, as you put this one there and you come down and write interest paid, go to the liability and check. Current liability. Is there any interest there? No.
That one is tax.
And then the interest I was not. We are doing it. So current liability, we have overdraft, trade payables. Is it not that one? Non-vertical.
Yeah, and current tax payment.
And current tax. That are the only three there. No interest. The change now for food figure there. But always that is what you do. So if there had been any interest, then come and prepare interest paid. Interest paid. So we bring in, if you want to do it in the account, it's okay. Interest payable has a credit balance. Yes. But whichever. We can bring the opening balance and put it there. Then the closing is also given. The closing is also given. No, I mean if when you are doing that now, the closing will be given. If the closing is not given, it will be 0. Okay, so interest at the beginning, then the one in the income statement. The one in the income statement, which is this one, will come. So this one, the interest was not given, so let's say dash. Then 650 is in the income statement. Then there's the pay supposed to be here, which is going to be in the bank or the cash. Then you get the closing. The closing will find itself also in the financial position. So if the closing is dash, it means that that interest in the income statement has been paid. It has been paid. So the payment is still 650. But this is the amount that you are supposed to do in order to get it. And it will be in the question So the opening will be for the 20, this one is 2011. So if there is any interest payable on this, then 2010 balance will be there. You bring it. You bring the for the year income statement. Then you leave a space for the payment. Then you go to for the closing, which will be also the financial position on 2011. Then you put it there, which is also dash. The same thing that you do for almost all the expenses of the income, so that you know how much was received. Which means that it has been paid. All of them has been paid. So far as we don't have a closing. So if there is a closing of 100, it means that we have only paid 550. If there is a closing of 100, we have paid only 550. Then you can write interest paid 550. I hope it's simple. If it is 250 there, it means that part is remain. If it is all the 650 there, it means that we don't pay for a year. So it depends on how the person is coming. But this one, there is no closing balance. So it means that all of them has been paid. So they say 650, right? This is this one is 650.
Sir,
Yes.
this is the increase in payables.
Mm-hmm.
Actually, the 2011 was 2000.
2,150. The closing have interchanged.
Yes.
No, okay. So the closing was 2,800 minus 2,001. Master is going to be 650. Just know whether that has been increasing or decreasing.
So where is positive? And then
And what did we say about whether we are adding or we are subtracting?
what's happening?
This is, no, I'm going to take it off. I'll just wait. So it is a payment. It is a payment. So it will reduce. You have to put brackets in there. I thought we were talking about it. I hope it's okay. We are paying, so it will reduce it. We are paying, so it will reduce it. Then we go to tax. So tax paid. The same way. You go to tax. You go and prepare the tax paid. So income tax. Income tax. Was there no opening balance?
Yes.
So balance at the beginning, or balance got forward. How much? 120. Oh? Okay. 120 at the beginning. 1,200. 1,200 at the beginning. We'll be near. So the opening is always going to be in the financial position. Current liability. Current liability. And if there is also deferred tax, it will also be in. So if there is a deferred tax, it means that you add the one in the current liability and the one in the non-current liability. The two will be for the tax, opening balance. Do you get it? The deferred tax is in the non-current liability. And the tax payable for the current year is in the current liability. So it means that there is going to be two opening balances. Add them together and I will put them there. You get it? So when you go, there is the deferred tax and the non-current, and there is also current tax here. Add them, just add them. Tax will be a liability. I would never. Then the tax that is also in the income statement. What is the tax in the income statement? So that is the current tax. You can say income statement. So that will also mean that there is what? Current tax provision and that or tax provision, deferred tax. All of them put together is the one in the income statement. Then you come in. How much? 2,550. So it means that you are supposed to have paid the opening balance and pay the tax for the year. But how much was paid, you don't know, but there is a closing balance. The balance can be down is how much? So that one to please be that one is also in the non-current, which is the deferred tax, and there's also one in the current. That will add the two together to be the closing balance. And the figure is 2200. So it means that they have paid part. So far as the figures are not the same, they have paid part. So how much have they paid?
1250.
So the cash book, the cash for the bank. 1250. That is how much they have paid. Okay, simple. So we come here, tax paid. 1, 2, oh, 11, 1, 2, 5, 7. Cash or bank, like the payment. And I'm in paid. That is it. So the difference is the pay. The difference is the pay. And it is a deduction to the bracket. I guess as for this small one, when you go and it is in, you just do it and you are good to go. So tax, it will be in the exam. So if the cash flow is coming, you work for tax, you work for interest. As for that, you do it. So you just have to know how to do it. When you go, you pick the opening balance, you know it will be in that and that. You add it, come and put it there. You come to the income statement, come and put it there. Get the closing, add it, come and put it there. And you get the difference. Come and write tax paid. The income, the interest will be the same thing. In the current liability, the interest opening will be there, the closing will be there. The one in the income statement will be there. Come and pick them, subtract, you are good to go. I think look at you and close, so it's moving there, be a cool. There is a open door and now I'm sitting in every. There's how they are. There's I'm saying you're going to do. Okay. Any question? Any question? So that would be the end for the operating activity. You add all of that together. So it will be net cash flow from operating activities. Net cash flow from operating activity, whether it's positive or negative. So if it is negative, you put bracket on it. If it is positive, you leave it aside. 2, 4, 6, 7. So that is for the operating activity. So please, all the operating activity for the 2, 4, 9, 10, 4 is the 9 or 6. Never have 12. He is not, person is not. You can leave some for the exam. Okay. Any question, please? Any question? Any question? Okay. Now let's go to the investing activity. Let them know one another. No. Okay. So with the investing activity, our concentration, as I said, will be the non-current asset. Non-current asset. So we go to the non-current asset. We go to the non-current asset and check it. The non-current asset. According to the other tire, maybe. So that's why I'm saying that even if you don't know it, just jump it. Go to the financing activity. But it is always about the asset. We check any addition to the asset, any disposal of the asset, proceeds from the disposal of the assets, any investment income. That is the only three things there. Increase or decrease, proceeds, and invest the proceeds received from investing in any other business. You are done. Okay. So let's check it. The assets. Non-current assets. At the beginning. PP. At the beginning. So there has been an increase, kind of. But is it really payment or just an increase? So you have to check all of that. So you can do the T account to check whether there has been actual increase, which is for payment. Other than that, any increase that you do will be a little bit wrong. Okay, but the additional information also says something about not depreciation per se. So you read that portion so that we can relate it to that.
There were no disposals of current assets.
Mm-hmm.
However, Quantum Limited does have some current assets classified as held for sales.
Okay.
As at the first March 2011.
Okay.
The depreciation of property, plants, and equipment for the year, the first March was
642. Okay. So we have to go and do the calculation for that so that we know. So if it is the T account that you are familiar with, fine. If it is this one too, so the asset account at the beginning, the balance at the beginning was how much? 5,400. 5,400. You put it there at the beginning. Okay. Then in the course of the year, there is what? Depreciation. So depreciation will be subtracted. It will be 640. I hope it's okay. Then it says that there was what? There was non-current asset held for sale. And we haven't done the non-current asset held for sale, that is IFRS 5. What it says is that if you have any non-current asset that you think that in a year it meets the criteria for sale, So here we are saying that it's supposed to meet that criteria. So for the sale, our management is willing to sell the asset within the period. Is the asset available for sale at that condition that it is? That means that it has met the S. Is it in saleable condition? Saleable condition. So if you need to repair it, it's not in saleable condition. You have to finish repairing it before it meets the criteria. Then the A is, are those who are supposed to buy it available? The availability of the buyer. Are they available? Then the L is the location. Have you been able to locate them as such? Okay. And the E is that it is expected that the sale happens within 12 months, within the current year. So if it meets that criteria, then you take the asset from the non-current asset and have to put it in the current asset. You move it from the non-current to current asset. And you have to use the fair value. You have to use the fair value. Any change in this, any change in the value is supposed to be treated in line with the standard. It's supposed to go to income statement. Or in line with PP, if it is upward, it will go to the other comprehensive income. Okay. So it means that the asset here is supposed to be moved down there. So if you saw the financial statement, go back to the financial statement. The current asset, down there, the question did not give us the figure. But in the statement of financial position, the current asset, you have seen that there is held for sale figure. So that held for sale has been taken up from the current and non-current to current. So it means that you have to take it out here and bring it here. I hope it's okay. So we come to the asset table and say held for sale. So it has been reclassified. So it's like you have taken it out. So in the beginning, and you took some out to go to where? The current asset. How much was taken? How much? The one is the current asset.
2,000.
2,000. I hope it's okay. So anytime that there is held for sale, it means that the non-current figure will reduce and it will come to the current asset. So if you want how much was taken, it's supposed to be in the current asset held for sale. Because in the non-current, you cannot come and write held for sale in the non-current. It must be in the current held for sale. Then the figure comes. That means that I have taken it from up there to down here. I hope it's okay. Alright. Any question on that? Then that is all for the asset. We have the closing balance. Balance carried down. The closing balance was how much? 9,500. If we have the closing balance as such, it means that the total here is going to be 11,500, 140, 140. Then the difference will be 3747, and that means that there's not an addition. I hope it's okay. So the addition, the difference is the addition. The difference is the addition. That means that you bought some of the assets with cash. So that is the addition. Then you come here and say purchase was there a particular asset mentioned or non-current asset or PB was mentioned? Non-current assets. How much? 6,747. I hope it's simple. The asset in the end can have a problem. You don't want the delay time or cash flow. Assets in the whole one. Other than that, there's nothing that really is difficult out there. Any question, please? Any question? Okay. This still the non-current. Non-current now has there been any other change? Is it not only non-current that is there in the question? Pardon? There is also intangible. There is also intangible. At the beginning it was 7. And now it is what? So it means that we have also pitches those intangible. So pitches of intangible asset. How much? 6, 29. Okay. So there is no additional information, but it was 0 and it is now. So you can do the accounts, it doesn't change anything. If you want to do the accounts, intangible. Opening balance is 0. And there is a closing balance. Balance carried down. 6,200. 6,200. So that means that the total is still going to be 6,200. 6,200. 6,200. So the difference will be an addition of 6,200. So you can still do the account of it if you want. But we are paying, so you put it in bracket. So if you are paying, if you are receiving, then that you leave it. So both we are purchasing. If you are purchasing, it means that cash is going. So if you are using that asset small, tender increase in an asset means that there's an outflow. But decrease means that there is an inflow. Okay, there is no other term concerning that. That means that you put them together. Put it together, and it will be 13, 5, 12 stuff. Okay, now 12 cards, 940. So that one is also what? Net cash flow from investing activities. Net cash flow from investing activities. Pardon?
Negative.
Sorry. So negative, we are adding it. Okay. Any question? Any question? So please, for investing activity, look at the non-current asset. Non-current asset. Just look at the changes in it. If there's any additional information, just do the asset table out there. Other than that, pick the changes and come and do it. And as I said, if there's any investment income in the income statement, investment income, so we come and add it, investment income. And that one is positive, we are receiving it. So proceeds, there is no proceeds. All of these are pieces of an asset, pieces of an asset. But if you dispose, then the proceeds that you receive will also be there. Okay. Any other question? And that, then let's go to the last question. Cash flow from financing activity. Cash flow from financing activity. Cash flow from financing activity. That one goes from the equity and the long-term liability. So let's check that section. The equity section in the financial position. Equity section in the financial position. Equity. So under the equity, we have the equity share of 5. You've seen that. So there has not been any issue of shares. Then we go to
8% loan.
the long-term liability. Long-term liability. We have the 2000, but we have the 8% loan notes. Have you seen it? So the first loan note, there was no change. Equity, there's no change. But the long-term liability, the other one, there's a change. So that change, and there's no additional information down there to show what happened. So it means that the change is as a result of getting more finances. So there has been an increase in liability in the form of a loan note. So 8% loan note. And the difference is how much? 7,000. This one we are issuing. So you can say that loan note issue. Loan note issue. So if you are paying for it, it may be that they are redeeming it. So we are paying back. That would be a negative. But this we issue to get the money. So it's going to be a receipt. Okay. Any question on that?